Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me remotely, we have Daniel Morris. He's a Senior Investment Strategist over at BNP Asset Management. And we're going to take a look at some technical indicators that suggest a broad market bottom may be into what's been a very volatile market. Daniel, it's great to have you with us. Thanks so much for joining. And it truly has been a volatile, 4 to 5 weeks for sure.
Yes. So with all the big moves in the market that we've seen, a couple of the indicators that we've been looking for and have worked in the past is suggesting that you've kind of reached the extremes of negative investor sentiment. So number one, of course, everyone tends to look at the put-call ratio when people are looking for a lot of protection against the market falling even further. Of course, we've had actually the VIX at higher levels than we saw during the global financial crisis over the last couple of weeks. And then also we follow the bulls to bears survey, which estimates what percentage of investors are bearish versus bullish on the market. And when those indicators get to extremes, and in this case, we're looking at the top 1 percentile readings of these indicators, and you get 2 or 3 of these all signaling these extreme levels, that's coincided pretty consistently with market bottoms in the past.
So all right, and that's what we're looking at in that first chart there with the exactly. two out of 3 bottoms, yeah.
Exactly. So if you look at the green lines on the chart, you can see it signals, if it's green, that 6 months later the market was higher. If the vertical line is red, 6 months later the market was lower. So of course nothing's perfect, otherwise we'd all be rich hedge fund managers. But it has about an 80% hit rate. Now that said, it doesn't mean that markets go up forever. So you can still see there are instances when a year later the market's bottom. So it's just kind of a shorter term indicator. We think markets have reached an extreme and we are overweight equities now in our multi-asset portfolios. All
right, let's move along to our next chart here. And this is where you're taking a look at valuations.
Exactly, because I think it's becoming ever more important. And if anything, the crisis has just exacerbated this tendency. Particularly with U.S. equities, you have to separate broad technology from the rest of the market. You can't compare the U.S. to anything else because of the importance and the dominance of tech. So what you've got here is the forward PE just for the broad technology sector. So that's including Amazon and Facebook and everything. And you can see we're around 18 times earnings, which historically actually is not low. It's only average. Whereas if you look at the rest of the U.S. market or Europe, you can see they're actually low for the levels we've seen over the last 12 years, 14 years or so. So we think on an absolute valuation basis, the U.S. market, ex-tech, and Europe are definitely attractive. The appeal for tech isn't the valuations necessarily, but its earnings growth potential.
Let's take a look at your last slide here. This kind of recaps everything that we just went through, but I definitely want to address the last bullet that we see there. The risk to this view, of course, is just how social distancing measures broadly play out. Will we be here longer? Will there be a reoccurrence? When will a vaccine be on the market? So there still are a number of risks to what the market is suggesting here in terms of a bottom, but the market typically looks 2 to 3 months out. So do you think that's where it is? Or, how will these risks come into play?
Well, we're going to be following like everyone else, particularly what happens in China and South Korea and Taiwan as they start to loosen some of the restrictions. That's going to be absolutely crucial. If you see there that as they do that, the number of cases spikes again, and those countries need to reimpose those measures, then the relative optimism you could say there's in the market over the last day or so could fade very quickly. So, a huge amount of uncertainty. If things aren't contained, if the measures need to go further, for longer, in more places, I think you would see lower levels for equities. But at this point, we're thinking that's not going to be the scenario that plays out.
All right, Daniel, excellent insight. Thanks so much for joining us.
My pleasure.
All right, and thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.